Well, welcome everyone to the August 2020 edition of Authentic Counsel Market Review. My name is Chad Frantzen. I'm the CEO and founder of Authentic Counsel. I'm a certified financial planner. And for more information about our financial planning and investment management services, you can visit us online at AuthenticCounsel.com. And in today's edition, we're going to go through a handful of slides just to provide you with an update on the current markets and the global economy and our view on how we're managing investments for many of you who are clients, how that relates to your individual accounts as well. One of the things that we've seen a lot in the news is how the economy and the market have been disjointed from each other as the markets have come back, and yet the economy is still struggling with high unemployment. By way of introduction, this is our disclosure page. This presentation just represents the opinions of our firm, Authentic Counsel, and we do recommend that you visit with a financial advisor for specific investment recommendations based on your age, suitability, objectives, and risk tolerances for that. So with that, let's jump right into it. I thought this was a good, an old proverb from the Old Testament. When we think about this world we live in today, it's just looking for sound wisdom and peace of mind is really, really challenging, just with COVID and with uncertainty with business and unemployment and trying to figure out what to do with our kids for school or those going to college. And there's this old proverb that says, true enrichment comes from the blessing of the Lord with rest and contentment and knowing that it all comes from Him. And I think when we parallel that with what we see in the news and on TV, like they have this thing called the CNN Fear and Greed Index. And so they update it, I think, daily. And so we live in this world where we're constantly bombarded with this continuum of fear versus greed. And so either in March, April, May, we're extremely fearful, like it's the end of the world. Now there's a lot of euphoria in the stock market, at least with Apple and Tesla and Amazon and other names, to where it's this greed effect of like, oh my gosh, I missed it. I need to buy more. People that have never invested in the market starting to invest. And I feel like, what I want to share with you here with this is just, we do want to find a place where we walk in contentment and peace as we think about our resources and our finances, and just believing that the greater good will prevail on that. And for some of us, it may mean turning off the news and not watching so much social media with that. So enough of that. Let's jump right in. A handful of slides here. This is courtesy of our friends at Wealth Shield Partners, one of our research firms. And this slide, which I've shown before, is an investment framework. So what you'll see in an investment framework is when we think about how do we invest a client's money, how do we look at the world and then make investment decisions, there's four main pillars that this framework looks at. The first is market sentiment. And as you can see, there's this continuum from red to yellow to green. So obviously, if it's in the red and orange, it's negative. And if it's in the light green to dark green, it's positive or bullish, as we would say. Market sentiment is mildly positive. It's a little bit off center of neutral. Really the big driver, what's been happening this summer, is just the Federal Reserve Bank's continued communication to the world that its monetary policy, which is our second piece of our framework, is going to be accommodative, which means that the Federal Reserve Bank and its policies for keeping interest rates low, for bailing out companies, for buying assets, and for printing money to keep the economy afloat, is really what's driving the stock market. So although we have a four-factor model, really, as we'll show on the next slide, it's the monetary policy, what the Federal Reserve is doing and saying, that's really driving stocks, some stocks at least, to all-time highs. In fact, tomorrow, Chairman Powell will be speaking, giving a very important speech about their policy on inflation going forward along these lines. The last two pieces of the framework are what we call market valuations and economic growth. And what you'll see is both of those indicators are negative. Now, market valuations just means if you go buy one share of Apple stock, how much do you pay for that based upon how much money, earnings, Apple as a corporation has. And so what this tells us is that right now, stock market valuations are at very high and extreme levels. So that does not mean that the market's going to go down. It doesn't necessarily mean that it's going to go up. It's merely telling us, hey, if you go buy a share of Apple stock, historically that's a very expensive price you're going to pay based on the valuation of the company. Again, many of these technology companies that have been driving the market, they may very well continue to go up in value into the end of the year. We don't know. But what this tells us is that, is it expensive, inexpensive, or fairly priced? That's what market valuations tell us. And then finally, economic growth. Many of you may have been affected by losing your job or having to lay off employees or having your hours cut. This is where the economic growth piece is. That's still negative. We have over 10% unemployment, and we've seen very high record numbers of corporations that are filing bankruptcies on that. Now, you may say, hey, Chad, I don't understand any of that. What we're wanting to do with this is just communicate what our framework is when we work with our research partners and managers on how do we make sense of what we invest in. This is the framework for it. So let's jump into the next slide. This is a slide of the S&P 500 SPY index. So this is a exchange traded fund that you can invest in, which represents the 500 largest US companies. Now, that being said, this chart, the blue line, shows the stock price going back 1 year. And so you'll see that here in February, around February 19th, it reached all-time highs. And then with COVID and the onset in March and April, it was at these very low levels. A lot of fear, a lot of panic going on here. But over the last 6 months, the market has just methodically worked its way back up to all-time highs where it was. Now, a lot of that has to do with the Federal Reserve and what it's doing to, in essence, be a backstop to the market. And so what that means is that a lot of people are buying companies, buying stock, because they believe that the Federal Reserve is not going to let a lot of these companies fail, that they're going to step in and be very accommodative with policies on money supply, interest rates, buying assets in the public marketplace. So as a result, the short term, currently you can see in this left-hand corner, our rating on this is a bullish rating. Now, it does not mean that every company that we want to invest in, nor does it mean that every company has had positive performance on that front. This next slide here, it was put out by CNBC. And as I mentioned before, the S&P 500 is the 500 largest publicly traded U.S. companies. Now, what this picture shows is that from February 19th of 2020 to August 18th of 2020, really that represented when the market was at its all-time high before COVID to where it is now. Today, it's back near those levels. Of those 500 U.S. companies, interestingly, 62% of those companies have had negative returns during the last 6 months, and 38% have had positive rates of return. So not all companies have totally returned back to normal. Many of them, depending on their sector of the economy, have been severely damaged by that. So really, there's a smaller number of companies that have done well in the last 6 months, even though the markets are back up to where they were. Now, this is really highlighted by what we call the FANG stocks. So in effect, there's 5 companies that are driving almost all the performance of the S&P 500. So some people have referred to this as the S&P 5. And those 5 companies are Amazon, Apple, Google, Microsoft, and Facebook. So those 5 companies of the 500 have really made up the bulk of the returns of the index for this year. So what that means is that more money is going into these 5 companies. Apple, for example, just became the first public company to have a value of $2 trillion. Now that's not billion, I said trillion. So to put that in perspective, Apple is now larger than the economy of Canada. So a lot of money going into these big tech names, reminiscent of the late 90s and before the tech crash of 2000. Again, we're not saying that the market's crashing, but what we've seen is just a lot of money is going into Amazon, Apple, Google, Microsoft, Facebook. We could even say Tesla as well. Just extreme valuations. And really, the majority of the other companies out there, some are positive, as this chart shows, but a lot of them are not doing well at all. So there's definitely a dichotomy, we would say, in the markets right now. So market review summary. Let me tie some of these things together. Again, we want to keep this presentation short just so we don't lose you. Many of you are clients, and so we're thankful for the trust you place in us to make wise decisions with your portfolio. In essence, we see that the stock market is in a positive trend while the economy is in a negative trend. And what that means for us as investors is there's a couple things at play. One, we need to begin planning, and in fact, we already have here at Authentic, for inflation. We're already seeing that. We believe that's part of the Federal Reserve's plan is to allow inflation to go back up above the normal 2% rate, whatever that looks like. But we need to make plans for how do we protect assets for rising inflation and market volatility as we enter the fourth quarter, as we go into the very hotly contested presidential election. We want to have some plans in place for that. The first bullet point here, positive trends. There are sectors of the economy that we like to invest in right now more than others. And so the ones that we find favorable in their trends right now are treasury bonds, technology, gold, industrial real estate, commodities, communications, consumer discretionary, and finally cash. Even with the market where it is, we still advise clients to keep some of their portfolio in cash so that when we see some opportunities for some of these companies to come back down in value, that we can take advantage of that. The other thing we encourage is with respect to inflation, many of those asset classes do well when we are in an inflationary environment, such as real estate, such as commodities, and stocks historically do well in an inflationary environment. Gold has been doing quite well as a hedge. Again, I mentioned the big 5 names that are driving the entire index. One of the things we encourage investors to look at is just look at how much concentration risk you have. If it's in your 401k or your IRA or your brokerage account, although we're okay owning these big names while the trends are positive, we just don't want to be too overly concentrated in them on that. One of the concepts that we use and we recommend is what's called a stop loss strategy. So what that means is that as long as the trend is positive, we're okay being invested in some of these names that are at very high levels. But we want to have a plan, in this case, a stop loss strategy, to where if these companies or if the market comes back below a certain percent, if it pulls back, starts to pull back significantly, that we have a level at which we would want to start getting out of some of those names when the trend changes. So in the industry, they say the trend is your friend. So as long as the trends are positive, we're going to stay in those positive trends. When they turn, we want to have an exit strategy, if you will, for how we're going to capture gains and protect capital on that. The last 2 points here as we close, for current investors, we really just recommend, as we've been doing this summer, is just review your diversification, review your risk levels for appropriate suitability. And if you don't have this already in place, which if we work with you at Authentic, you do have this in place, is to have some type of stop loss protection in place and also invest in assets that will do well in rising inflation, some of which we've given you some examples of that on that first bullet point. For new investors, we talked to a lot of people who are brand new to investing and they want to know how to get started. Really, the best advice I would give you is start dollar cost averaging, which means set aside a certain dollar amount each month and invest it into a diversified fund. Now that can be in a 401k or an IRA or a brokerage account, but just set aside a little bit of money each month and start averaging into the market over the next 9, 12, 18 months. And I think you'll find that you'll be pleased with the results when you look back a couple years from now on that. So that's our market review summary, just based on trying to condense all the research that we read and talk to for that. And then finally here, just this quote to encourage us as we think about investing in really life in general. The hard part is discipline, patience, and judgment. And as investors, as business owners, as parents, as friends, we need discipline, right? To know where to walk in wisdom and where not to walk. And so this quote says, we really need a discipline to avoid the unattractive pitches, to use a baseball analogy, that are thrown, patience to wait for the right pitch, and judgment to know when it's time to swing. And that's really our mindset with our team here and with our various research partners for clients and for those that we consult and provide financial coaching with. Is we want to walk in wisdom and have a disciplined approach, be patient, but also just follow the trends until they change and have judgment to know when that is. So with that, that concludes our brief August market review from Authentic Counsel. Again, thank you for watching. And if you are a client of Authentic Counsel's and you have specific questions about your investment portfolio or anything in here, please reach out to us if you would like to learn more about our services, or if you'd like a second opinion on your investments. Feel free to contact us through our websites the best way, AuthenticCounsel.com. And again, this is Chad Frantzen, CEO and founder of Authentic Counsel, a registered investment advisor. And with that, that concludes our market review for today, August 26, 2020. Thank you so much for joining us.